Hello everyone and welcome to today's video. If you are new to me, my name is Latoria. I help construction related trades and specialty contracting companies save on average of $10,000 to $20,000 in taxes per year, as well as scale to multi-six figures and beyond status within their business utilizing tax and accounting strategies. Now in today's video, we're going to talk about converting over to S corporation status and if this strategy makes sense for you. So first off, we have to understand that an S corporation is not an actual business entity. It's a type of tax election. So you're electing or choosing through the IRS on a federal level to have your LLC, partnership, or corporation taxed as an S-Corp. Now what this election does is it allows the responsibility of paying income tax to pass through the business and flow down to the individual. It also allows the owners to take a salary and a distribution from the company under reasonable compensation rules, and this results in lowering the overall taxation of the business. Now, there are requirements that must be met in order to receive S corporation status. The first one is there cannot be more than 100 shareholders or owners of the company. And these shareholders must be allowable shareholders, meaning individuals, certain trusts and estates, as well as certain tax-exempt organizations. Now you also have the payroll requirement for shareholders and owners considered to be employees of the company. This payroll must meet reasonable compensation requirement by the IRS. And we'll get more into what the reasonable compensation requirement is later in the video. You also have the one class of stock requirement. So S corporations can only have one class of stock. So if you meet these requirements and your business is in a position profit margin wise, then you can go ahead and move forward with the process of electing S corporation status. Now let's get more in depth into the payroll requirement because there are a lot of moving components when it comes to running payroll. Now, the first thing is when it comes to payroll, you have to pay yourself reasonable compensation. And how you would determine that number is you would look at the average person who does the same line of work, how much that person makes per year, and pay yourself around that number. Normally, this reasonable compensation amount or salary would be about 30 to 40% of your company's revenue. So we first want to make sure that the company is profitable. So before switching over, be sure that the company's net profit margins are at least 30 to 40% on an annual basis. Now, these are numbers that you should already be knowledgeable of. So you should know your profit margins. You should know the percentage of expenses you have. You should know your gross sales from a monthly to an annual basis. And if you don't know the financials of your business, then we can't make good decisions to grow the company, such as converting over to an S corporation. So we want to make business decisions based off of the data and facts. So it's important to fully understand how your business is performing financially to make good decisions to grow the company and not hurt it. Now, to go along with being able to pay yourself a reasonable amount, you also have to be able to pay payroll employer taxes. You also need to take into consideration your state's requirements when it comes to payroll and employees. You have workers' compensation, you have unemployment insurance, you have new hire reporting, you have tax reports to submit to the IRS and the state on a quarterly basis. So as you can see, there are a lot of moving parts when it comes to just payroll itself. So you have to take all of these moving parts into consideration before converting over to S corporation status. This is definitely something you don't want to rush into, so be sure to talk to your tax professional or accountant to see if this strategy fits your specific situation. You want to be sure that your business is functioning properly and already in compliance before switching over. So if you already have a decent amount of net profit margins, then you should already be making estimated tax payments on a quarterly basis. If you're required to collect sales tax, then you should be making those sales tax payments in a timely manner. You should be caught up on your tax returns. So just be sure that you're already functioning properly and in compliance before switching over to S corporation status. Now, specifically to the construction industry, so to the landscapers, electricians, roofers, painters, and so on, I highly encourage you to consider this strategy and implement it within your business. And I say this because a lot of times the owners are out themselves on a job site helping to complete projects alongside their employees or workers. So this is a great strategy to lower taxes overall. Now, if you need help in this area of knowing your data and financials, or if you already know and you're ready to take that step to move forward in converting your company over to S Corporation status, go ahead and click the link provided in the comment section and schedule some time with me to get this done for you. Also, don't forget to download your free ebook that gives you a complete list of everything that is a write-off to you and deductible come tax time. So that's all I have in today's video. I hope you found this information helpful. Thank you all for watching, and until next time, believe in your vision.